Hey you guys, this is going to be the video for Section 2 Part 2, kind of just picking up where we left off in Section 2 Part 1 video. And if you're following along, like watching this video while looking at the text, which is highly recommended, we are on page 12 of Section 2. And we're going to start out looking at sales returns and allowances. So basically what this is explaining is when we have a customer return merchandise for whatever reason, it could be damaged or defective. And so there are several ways. You guys have probably experienced several ways of you either get your money back, like you get cash back, or maybe you get like a store credit or a sales allowance, which just could be like if you're returning an item that costs $20, maybe they give you $20 store credit, meaning you get $20 off your next purchase, basically. So it's kind of an allowance. So depending on the store and its return policies, that's what you could get. So we're going to be looking at what's called a sales returns and allowances account. This type of account summarizes the total returns and allowances for these returned products. And this is considered a contra account. So the sales returns and allowances account is considered a contra account. It's basically it offsets the related account, which would be sales, which is a revenue account. So this is a contra revenue account, meaning it offsets our sales account. So when we sell an item and we're getting revenue, we're recording that into our sales revenue account. So now when someone's returning an item, that's when we need this sales returns and allowances contra account to record the returns. So we're going to go over an example of that in just a minute. I wanted you to just see how this account is set up. So here's our sales account, which you should be familiar with. It's a revenue account, and it was a increase on the credit side with the normal balance on the credit side, and then decreases on the debit side. So now our contra account, a contra revenue account, is going to be just exactly the opposite. So with sales return and allowances, that's our account name. We're going to be increasing on the debit side and decreasing on our credit side. Okay, so let's take a look. I think my next slide here has us looking at an example. So we're going to look at an example here in a minute. Also on this page, you'll see what a credit memorandum is. So basically it's just a memo or a note that lists the details of a sales return. So basically you're going to have to, with the customer's charge account, you're going to be crediting that account back the money that for the returned item or the returned amount. So there's an example on page 13 here. And what it's showing us, let me see if I can zoom in on this a little bit. So what it's showing us, or the example it's taking us through, is on January 10th, Olympic Sportswear issued a credit memorandum to Alan for the return of merchandise on his account. So $100 plus the $6 sales tax. So Alan, or previously, maybe like a week before, had come in and purchased an item for $106. It was $100 plus $6 sales tax. So now something happened to that item and he's returning it. So here's how we show that the transaction of the item being returned. So pay close attention to this because I think you do this on your first assignment. So first we want to identify the accounts that are going to be affected. We have our accounts receivable, the controlling account, and accounts receivable, the subsidiary account. Okay, that's what we talked about in part 1 of this section. So if you're unfamiliar with that, maybe go and review that section of section 2, part 1. And then we're also going to be looking at our sales returns and allowances account, and then also our sales tax payable account. Okay, so again, there's 4 different accounts involved in this one transaction. So now we need to classify these accounts. We said we're using accounts receivable and both controlling and subsidiary. They're both asset accounts. Okay, so that should tell you something about how their T account is set up. And then we're looking at sales returns and allowances, which is a contra revenue account. So we said it's going to be opposite then of our revenue account. And then we're also working with sales tax payable, which is the payable should be a sign that it's a liability account. So then let's analyze these accounts. Our sales returns and allowances, that's going to be increased by $100. So the item that he bought was only $100, and then he paid $6 in tax. So we're putting that $100, that's going to increase our sales return account, okay? So we're increasing our sales return by $100, and then that $6 he put towards sales tax, we're going to then decrease our tax payable account by that amount. So then accounts receivable and the controlling and subsidiary are decreased by, this should say $106. Not really sure where they got on $159, but you guys know we're doing this, it's $106 total. So that's what's going to be given back to his account. Okay, so we apply our debit rule to our contra revenue account and to well, just to our contra revenue account right now. So we're going to debit our sales returns and allowances, that's the name of our account, for $100 because we're increasing it by $100. Then we're going to decrease our liability account, which is the sales tax payable. We're going to decrease that by $6 because we increased it when we made the sale for $6. So now we get to take that $6 out because he is returning the item. So we're going to decrease it. So we're applying the debit rule to both of those recordings. And then the credit rule will apply to our accounts receivable accounts, the controlling and subsidiary, for $106 each. Okay, so this is what your T accounts are going to look like. Another typo right here, there should be $100. We're putting $100 into our sales return account. And then we're crediting our accounts receivable for $106 each. You can see that here. And then we are also debiting our sales tax payable. So now some of you might be thinking, okay, if our debits are supposed to equal our credits every time for every transaction, something's not adding up here. But keep in mind, this subsidiary account is recorded on a different ledger. So when we look at our debits equaling our credits, we're only looking at accounts receivable, sales returns, and sales tax. So those each, this is $106 here, and that equals our credit of $106 here. So don't let that throw you off. This is recorded in a different ledger. So that's why it looks like we're recording that twice, because we are in two different ledgers. So here's what it looks like in our journal. We are recording our debits first in our journal, because we always put our debits first. We are debiting sales returns for $100 and sales tax payable for $6. And then we are crediting our accounts receivable account for $106. And you can see that they kind of give you an explanation here about when you record it. You need to be putting a mark through it to say that you recorded it in both places. I would like you to start doing that. I don't, from what I've seen of the assignments, they don't have you record it in two different ledgers, but they might in the long run. So when you do jot this transaction down into your general journal, make sure you are putting that slash to let me know that you know you should be recording that in two places, okay? Because that's with the controlling and subsidiary account for accounts receivable, that will be recorded in two places. So again, here's another example of the journal, and then it shows you the ledger accounts. So if you want to take a closer look at these, go right ahead. They just kind of show a balance, a previous balance, and then our transaction here is January 10th. So I definitely encourage you, if you're confused at all, to definitely take a closer, how many times can I say definitely? Take a closer look at page 13 and get a better feel for that if you'd like. Okay, let's move on here. So now we're looking at analyzing cash receipt transactions. Basically, I think most of you probably have a good idea of what a receipt is, like the purpose of a receipt. So when we're working with cash transactions, a lot of these transactions listed here are considered cash transactions. So basically what your receipt is, it's proof of that transaction. So that if you do have an issue with an item and you want to return it, you need to take that receipt to prove that you bought it in the first place. And I think you guys are probably familiar with that. So with cash sales, the business just receives full payment for the merchandise in cash. So the receipt then is just proof of that cash sale. Charge customer payment. So what this is, it's just it's when a customer makes a payment on their account. So then a receipt would just be proof of the payment on the account. And we have bank card sales. This is when the amount is credited to the business's checking account on the same or the next day. So if someone were to use a debit card or a credit card through the bank, then that is treated like a cash deposit because it goes into the business's account either that evening or the next day. So they discount it as a cash deposit. And then there's other types of receipts. Receipts are prepared for other cash resources, whether it's from a loan, maybe the sale of an asset, or interest on an investment. Okay, and then cash discounts. This is a cash discount is a discount provided when the payment is made within a certain amount of time. Some stores have a policy. It definitely you'd have to look into their credit terms to see what their policy is on this. But something you're going to be seeing in our upcoming announcements and the exam are these numbers that look like fractions here. So what this means, and we talked about this a little bit in section 1 or in part 1 of section 2. But what this means is, so when you see a 2/10, that means the customer can deduct 2% from the merchandise cost if he pays the full amount within 10 days. So he bought this item on account, and if he pays for it all in 10 days, he can deduct 2% of the total cost from his payments. Or, so then you see the or in over 30 here, or if he doesn't get the full payment done in 10 days, then he has 30 days to make the full payment. So that's what those numbers mean here, okay? And I see we have an example on page 16. So on page 16, they're showing us how to record a cash discount. So basically, and I'm kind of running out of time for my 15-minute window here, so if you would like to look through this on page 16 yourself, it explains a little more about the 2/10 and n/30, what that means as far as the discount goes. But here's an example. So Olympic Sportswear sold $500 worth of merchandise on account. The transaction was recorded as a credit to sales and a debit to accounts receivable. So the terms that the store gave this high school, if they can pay within 10 days, that means they make their full payment by January 15th, they get a discount. So in other words, Olympic Sportswear will receive $490 after a discount of $10. So if they make that payment in that 10 days, they get that discounted rate. So refer to this page and these T accounts for the setup and to just take a closer look at this example here. I'm running out of time because I want to keep this under 15 minutes. So if let me see if I have anything else. Okay, and then here's a last look. I'll have this PowerPoint available in our doc sharing if you'd like to use this as like a vocab sheet for you. And if you guys have any other questions, please let me know.